Hello. So fixed income actually looks very complicated when you begin doing it for the first time in level 2. The five readings looks like, they are never going to end. But in reality, the weightage is very high. You have around 10 to 15 percentage of the weightage, and you can expect easily at least around 2 to 3 item sets or vignettes. So on an average, you'll have around 8 to 12 questions, which is very high. And of course, as important as equity, correct? Now, there are only five readings. As I mentioned, these five readings are basically your term structure, arbitrage valuation, and then comes valuation of embedded options. Now, these three readings are actually interconnected. Okay. So, what normally you should do when you revise, you should do these three readings together and then solve as many questions as about these three readings together, right? Then you can do credit analysis models, which is related to the credit value adjustments. And then finally, you have CDS, which is very theoretical in nature. Uh, Hardly any calculation except cheapest to deliver. So majority of the concentration from your revision point of view should be on the first three readings, where if there are three case studies or vignettes expected, I expect out of those three, the first two to come from the first three readings, right? Very high possibility of the vignette asking you the backward induction. That is what we are going to do, which is very easy considering the amount of time that we've spent in the full course in the calculation of term structure or in the calculation of forward rates, which is the same method that I teach in level 1 also. In the level 1 also, I teach in the same process so that in level 2, calculating forward rates become relatively easier. Got it? So let us begin with the term structure, arbitrage-free valuation of the bond and the valuation of option embedded bonds together. Okay, first three readings we'll understand together and then we'll move to the next two readings. Clear? Fixed income, as I said, I'll repeat again and again during the syllabus that it looks very complicated, but it is in reality not so complicated. Okay, let's see the common theme. See, individually, each there are so many micro topics, but they all actually involve around the same thing. Okay, so see, when we started the first reading of fixed income, majority of the time that you must have gone through is spending on understanding the spot rate, forward rates, how to calculate the forward rates, and so on. So if you see, I'm just flipping around the pages so that you can also do that with me. Initially, we spend our time into calculating the spot forward. Now, you don't need to revise that because when we are going to do backward induction, right? Bootstrapping basically I'm talking about. During that time, that is anyways revised. So forward is already revised at that point. Got it? Now, forward is based on the term structure, but the market expectation might be higher or lower. So if the market expectation rate, the expected rate is much higher or lower, you need to compare that with the forward and take a decision whether to buy the bond or not, right? That is what we will proceed and see how to do that. Now, there are different models, everyone. The forward pricing model is based on the concept of no arbitrage. Remember, the price of the bond should be based on the forward discount rates. If not, there is a possibility of arbitrage, right? This is forward pricing model. Forward rate model is based on the forward rates. Now, in reality, there's not a much big difference between the two, right? So forward pricing model, they basically rely on the no arbitrage pricing, correct? And the forward rate model is quite on the similar lines. But what is the difference here? The difference is that forward rate models are based on the expected forward rates. These rates can be pulled out from the relevant spot rates or zero rates, or you can basically in exam they will be providing you that, and then you can find out the forward forward rates and accordingly you can value, correct? Now, one of the basic difference that generally students ask me that in exam, are they going to test this, that there's what is the biggest difference between both? Now, in reality, you know, if I were to ask what is the difference, the model, see, the both model rely on one concept that the forward rate can be derived from the spot rate or the zero coupon rates. And through that, you can find the value of the bond, right? So forward rate model and forward price model. In forward price model, you actually use the discount rate of a zero coupon bond. In forward rate model, you first derive the forward rates and then you find the present value of the bond. In reality, the pricing of the bond has no difference. No difference. Got it? That we will discuss it when we go to the when we go to the backward induction or bootstrapping. Okay. So wait till bootstrapping because all these micro concepts are connected together or understood when we do the bootstrapping. Okay. So all of this initial time that we spend during the syllabus was reaching to the point of as to how to do the bootstrapping. Okay. This is the basic information that we know. Par bond is a bond whose yield and coupon are same, correct? Now, how to basically find the value of the bond or the intrinsic value of the bond if they give me the par rates. Remember, par rates are the rates of a bond which is trading at par, means its yield and coupon are same, right? So very important is how to do the bootstrapping because that is the basic concept throughout the syllabus, throughout the fixed income syllabus. So here in exam, they just give me the par rate. Now what I need to do is that taking the par rate, which is also the coupon rate and discount rate, we need to find the relevant spot rates. So how to find the spot rates from the par rate is a very important task. And there is a high chance that in exam, this might be asked to value upon. So these are the par rates. Now, assuming the par rate for 1 year bond, let's say a 1 year zero coupon bond, which is going to mature after a year, will pay me $100, correct? A zero coupon bond. But a par bond is a bond which is always trading at par and the coupon and YTM are same. So if it's a par bond, which is not a zero coupon bond, in that case, if they give me for first year, the rate is 1%, means its coupon is also 1%. And since its discounting rate is also 1%, its present value will be equal to par. So a par bond who's going to pay me after a year $100 as the par value and $1 coupon, the present value, the discounting rate of that is going to be my spot rate. Correct? That spot rate for first year is always the same, so we don't have to calculate. But when I go to the second year par bond, where I will now consider this as a separate bond. So 1.25% will be the coupon in first year. In second year, I'll get 100 plus 1.25. I need to bring it to the present value, but the present value should always be par. Correct? So what is missing here is that I have this first year spot rate. By doing this equation, I will be able to find this 2 year spot rate using this concept. So I'll find out first the 2 year spot rate, then the 3 year par rate I will use. This I will consider the coupons for the 3 years, and using the 2 year and 1 year spot rate that we got from the previous point, we will find the 3 year spot rate. Basically, you will see that the par rate and the spot rates are not the same. There is some difference. And what is this concept? This is bootstrapping the spot rate. You are basically converting the spot rate. You are trying to find the spot rate from the par rate. Got it, everyone? Right? So our first section of the beginning of the term structure went into deriving the rates. Correct? Spot rate, par rate. Spot rate is for zero coupon, par rate is for a bond which trades at par. How to derive spot rate from the par is very, very crucial, helps us later on also. Got it? Then we have the forward price relationship. We've already discussed this. We've already got this correct. So there's no, complicated thing here. As I was discussing that the forward rate that you derive from this no arbitrage concept, you need to have an expectation. You need to compare that with the expected spot rate. Expected is what you expect. And the forward or the future price is one that you derive from the curve, okay, from the spot curve. Now, guys, this expected rate, if your expectation is that the rates will be higher than the forward rates, remember in bonds, higher expectation rate is a good sign or a bad sign? Everyone, if the expected spot is higher and currently the forward is lower, remember if the rates are higher, the bond price is lower, correct? So if they both are same, your realized returns will be same as the YTM of that particular maturity. But if your expectation is that the rates will fall, then the forward rate, which is basically been mentioned. So what happens in that case, if you think that the rates are going to fall, right? Basically, when the rates fall, the bond prices goes up. So it's better you buy the bond. If you buy the bond, only then your realized returns will be higher. Also, if the rates are expected, your expectation is that the rates will increase than the forward rate, then you should not buy the bond because the bond prices will fall. And if you buy the bond, then you will lose the money. So you should rather short the bond, then your realized returns will be higher than the YTM. Got it, everyone? We did an example related to that, which you can compare. Now, there's no complication there. What is very important throughout all these examples that we did in the class, I showed you both the phases. What happens when you, let's say the YTM is increasing. First, I showed you a normal picture where if the yields are flat, they don't change, then your holding period return is also the same, if you recollect. So if throughout the maturity, the rates don't change, so whichever you hold the bond for 1 year, 2 year, or 3 year, your holding period return is the same. But in the second scenario I gave you, what if that I'm planning to sell the bond and the yield goes up? Good decision or a bad decision? If you plan to sell the bond before maturity and the yield goes up, good or bad decision, everyone? It's a bad decision, right? Because yields are going up and you're selling the bond, so you will be selling the bond at a lower price. If you sell the bond, then what will happen to your holding period or realized returns? They will be below the YTM. So see here, guys, what happens? In reality, my 2 year spot rate was 4%, but my realized return was only 2%. So if you plan to sell the bond before maturity and if the yield goes up, that's a bad sign. That's a, that's a scenario that will not yield you positive results. Got it, everyone? Right? So here I have kept the expected rate as 6% and 7% instead of 4 and 5. So instead of not 4 and 5, instead of the forward rate. So instead of the forward rate that we derived, if the expectation is higher than the forward rates, then you should not sell the bond. You should not buy the bond, right? So you buying the bond, sorry, my mistake. When you sell the bond and at that time if the yield goes up, that's a wrong decision. Clear? But if you see in the third scenario, the expected rate is going to fall. And at that time, if I'm going to sell the bonds, I will get a better price. So when you are planning to sell the bond at that time, if the yields go down, you will get a better valuation. Therefore, your holding period returns are higher. Conclusion is that today, when you buy a bond, you should only sell after a year, or you should sell it when the yields are expected to drop. If not, it's better you hold the bond till the maturity. Clear, everyone? Okay. Tell me one thing, higher the maturity, the yield will be higher or lower? The yields will be higher, right? Correct? Now, this is where we understood a very interesting concept called rolling down the yield curve. Actually, I've seen this concept in level 3 also. So what I would suggest, this is a very, very important topic. I would suggest you to highlight or basically, mark this as important. See, normally the yield curves are upward sloping. So higher the maturity, higher is the yield. Correct? Now, suppose I'll directly go to the example rather than doing the entire explanation. Suppose you're planning to invest for 5 years. Now you have two choice, either buy a 5 year maturity bond and hold it till maturity, right? So in that case, you will make a yield of 3% as per the table here. But what if you buy a 20-year bond, correct, and sell it after 5 years, then it becomes a 15-year bond. As of date, if you look, a 20-year bond will have a higher yield or a 15-year bond will have a higher yield. A 20-year bond will have a higher yield, right? Correct? Now see, 20-year bond, when you buy, it's cheaper. It's available at 4.5 yield. So it was available at only 80.49. Now, the bonds prices generally are assumed to be as per the constant yield price trajectory. So as per the constant yield price trajectory, if its n becomes 15 after 5 years, its price should be something else. Assuming the yield is same. But in reality, the concept of rolling down the yield curve says that After 5 years, the bond is no more 20 years, so its maturity is less. So why should its yield be at 4.5%? Rather, its yield should be lower. So instead of selling the bond at a lower price, because the yield is not going to because sorry, my mistake. What happens here is that ideally when you have bought the bond, you bought a 4.5 bond at a price of 80.49. Correct? Now, if you sell this bond after a year, you should make the same yield or lower yield. You should probably make the same yield, right? If the yields don't change. But the concept says that here, assuming the bond is now a 15-year bond after 5 years, so its risk should be assumed to be same as a 15-year bond, not as a 4-year bond. So its yield will actually be dropping. And since the yield drops, the bond is now revalued at a 15-year yield, which is 4%. Now, because of the drop in the yield, what happens? The bond prices will rise. So basically, when you're going to sell the bond, you will get a higher valuation. This will result in a return which is actually more than what you would have achieved. Got it? So, due to this thing, what happens? A bond investor can actually make much more returns by rolling down the yield curve. What is rolling down the yield curve is basically buying a higher maturity bond and selling it after a specific period for which you wanted to hold the bond. And the advantage is that since the yields will go down because now it's a lower maturity bond, you will get a relatively higher returns. Understood? So, the yield curve, one biggest assumption here is that the yield curve structure remains the same. Only then the riding the yield curve makes sense. So one first assumption is that the yield curve remains the same over the life and it is upward sloping. If these two assumptions are not there, then the riding the yield curve does not make sense. So upward sloping yield curve, remember, and the yield curve remains unchanged throughout the maturity, then riding the yield curve generates higher returns. Got it? Everyone? Clear? Right. Okay. Then there was a discussion related to swap rates. Swaps, a plain vanilla swap where we convert fixed to floating. Remember, in swaps, one party is paying the floating rate, the other party is paying the fixed rate. So the price of the swap, which is the fixed rate of the swap, is derived in such a manner that the present value of the floating and the present value of fixed, they both match. So if I want to match the present value of fixed, the fixed is going to pay a fixed rate, which we don't know, and the floating will be paying based on the LIBOR rates, correct? Or based on the market reference rate. Now, the rate which matches these two is what we call as a swap fixed rate. Is what we call as a swap fixed rate. How to derive the swap fixed rate? The process is same as what we did for a par bond. Remember, in a par bond, the price of the bond is always at par. Here, what we do to derive the swap fixed rate, we assume a fixed rate for across the maturity and compare that with the floating rate. Now, if you notice here, the swaps, the fixed rate coupons or the fixed rate payoff and the floating rate payoff, they all are discounted by the spot rate. So if I have the spot rate for each period, what I can derive is the swap fixed rate for each period. Are you getting my point? Same like what we did for the par rate. So we can actually derive swap rates. What is going to be the 1-year swap rate, 2-year swap rate, 3-year swap rate. So if you notice here directly, sorry, see here, we have the 1-year spot rate. Now assume you are going to be in the swap. So for 1 year in the swap, you will pay a fixed rate, correct? So what is going to be the present value of a fixed rate bond? Present value of a fixed rate bond. So here, what are we going to do? Assuming that after 1 year, you're going to pay a fixed rate on a fixed bond, right? So what is the fixed rate which will bring me the present value same as the present value of a floating rate bond? Remember, a floating rate bond's present value is always the same. Its coupon changes, its price doesn't change. So why have I written one? The one is for the fact that the present value of floating and fixed is always the same. Correct? Now, the rate which makes its value equal to 1 or the value of the floating rate, that is going to be my swap fixed rate for one period. Once I get this rate, I can utilize that rate to find the 2 period. I have the 2 year spot rate also, so I can utilize that to find the 2 year and 3 year. I have all the spot rates, so I can find the swap fixed rate. To be straightforward, I've rarely seen a question where they ask you to derive the swap rates, right? Mostly they will ask you a situation where they're going to ask, make it very theoretical in nature. Okay. So don't worry too much about how to derive the swap fixed rate. You can actually go ahead and practice it. It's pretty much simpler. Assuming like a bond, correct? So bond, what is the fixed coupon on the bond? That's what you're looking for, right? That is going to be your swap fixed rate. But the process is same as the par bond. However, as I said, it's rarely asked in exam. And even if it is asked, the process of valuing a risk-free bond or a par bond or a swap fixed rate is exactly the same thing. No brainer there, no complication there. And of course, we see that in the questions also. We'll see that in the questions as well. Another important thing from this topic, which is actually very important, is what we did, the different types of spreads. Now, what are the different types of spreads? We had actually summarized all the spreads here. So I can perhaps put up all the spreads here. And now these spreads is what I've put up in the formula notes. So going to the formula notes, what we can do is that we can basically, we've written it in the class. So what we can do is that we can summarize all the spreads here. Now, first on the screen, you see the swap spread. Swap spread. So this is my first spread. Let me just summarize it. Okay. My first spread is a swap spread. Swap spread is the spread between the swap rate, let's say between a corporate, right, and the treasury rate. So here you're comparing two things. You are comparing a corporate bond rate in the in the LIBOR market or in the swap market and a treasury rate. Now, what is the difference between both? Well, the difference is that the treasuries don't default. So this rate swap spread is always positive. Everyone with me? Confirm, confirm, confirm. Understood, right? It's related to the credit risk and it is always positive. Correct? Now, see, swap rates are generally the rates derived, from the interbank market, or these are relatively more safer because compared to the corporate bond. So in the swap rate, how do I get the swap rate today? Instead of LIBOR, we use a different rate. We use MRR or SOFR, correct? So swap rate here, the swap rate exactly is generally derived from the interbank market. Okay. Now, it's not the borrowing and lending for a bank, but at the rate at which one bank can borrow from the other market, that is in the swap. So in the swaps, there can be any corporate, by the way, also the institutions. So the rate there is considered as a swap spread. Now, sometimes instead of swap rate as a reference, you can take an individual bond, your individual bonds rate as well, or your individual bonds YTM. Correct? Now, tell me one thing. When you do that, when you take the yield of your risky bond and instead of comparing that with the treasury, you compare that with the swap rate. Now, what is the difference between these two? Both are risky. Correct? Now, I spread is the spread of your bond over the swap rate. Okay. Now, this is generally used in a case where the swap rate for specific maturity is not available, right? Now, again, what is the biggest advantage of using this spread? Why do I use this? So it not only measures the credit and liquidity, but not over the treasury. See, over the treasury, definitely the yields are higher, but it measures the risk over the swap rate. Got it? So when I spread is the yield of my bond, let's say my bond, over and above the swap rate. But what is a swap spread is how far is the swap rate or how much additional is the swap rate over the treasury. Okay. General spread is what we define as our yield over the treasury. But that now, if you notice, that can be separated into two parts. One is the swap spread, that is the difference between the swap rate and the treasury. And the second is I spread, that is the difference between my yield and the swap rate. If you combine both, you will actually get your bonds yield spread. Understood, everyone? If you combine both, you'll get your bonds yield spread. Now, these spreads are based on the YTM. Can you tell me what is the difference between YTM and the yield curve? YTM assumes a single rate across all maturity, correct? But the yield curve is generally upward sloping, where each maturity has a different yield. So, a corporate bond's yield curve will be above the government bond or the treasury yield curve. Am I correct? Right? A corporate bond's yield curve will be over and above the treasury yield curve. Correct? Right. So this is the parallel shift in the yield curve. The extra yield that you see over and above the treasury curve is what we call as Z spread. So Z spread, why is it called Z? Because zero volatility. It is the spread over and above the spot curve for a risky bond. Everyone with me? Correct? But is Z spread appropriate for a embedded option bond? Please tell me. Is it appropriate for an embedded option bond? No. For embedded option bond, we are going to see later, which is the spread that we compare for an embedded option bond. For an embedded option bond, we compare OAS, option adjusted spread. Clear for embedded option? So OAS is not discussed here. We are going to discuss that when we do the embedded option. But along with all the spread, remember Z spread for option free bond, OAS for option adjusted bonds or embedded option bonds. Correct? Two more spreads, very important, are the TED spread and MRR-OIS spread. Both are the spreads which tells you the risk in the banking sector. Just what is the difference between both? In the TED spread and in the MRR-OIS spread, you will notice in both we use the MRR, market reference rate, correct? And that is compared to the T-bills. T-bills are 20, 30, 30, 90 days T-bills, correct? And in the MRR OIS spread, you will notice it is overnight interest swaps. Basically, these are the overnight rates. Okay. Most of the times, who uses these rates? Banks, when they borrow or lend with each other. Correct. So TED spread is the amount by which the MRR, market reference rate, is over and above the treasury or T-bills rate. Clear? Why is it called TED? Because T stands for T-bills and ED stands for euro dollar. Euro dollar is the MRR or the LIBOR. It's the borrowing and lending of dollar outside US. The word euro means outside US. I have a question: which spread can be used for money market instrument? So here, see, we are going to deal with 5 spreads. Money market is less than 1 year, right? So TED and MRR OIS both can be used for money market. But understand the difference. TED spread is the spread of MRR, which is a euro dollar, not a government control, interbank rate compared with T-bills. T-bills are also less than 1 year, correct? MRR OIS is comparing the MRR with the OIS. OIS is for very short term, for less than 1 year. Both are for less than one. Both the spread. OIS is for overnight, 1 day. Both are the spreads. You can compare it for money market to answer your question. Both can be used because both use the reference, which is less than 1 year instrument. And in both cases, you are using, why are we calculating both the spreads? We are calculating both the spreads to understand the risk in the banking industry or banking sector. Why is that so? Because banks are the ones who borrow at MRR, or banks are the one who use OIS. Understood? Correct? Just to inform you, OIS, overnight index swaps, is the interest on unsecured overnight lending between the banks. Understood? Clear? So OIS is 1-day borrowing, right? TED compares that with the T-bills, but T-bills are for longer maturity. Generally, we use 3-year maturity T-bills. Clear? Correct? Both the spreads, when they rise, they signal increase in the bank risk, increasing of the risk in the banking sector. Understood? The MRR OIS spread was previously also, it had a different name. It was called as the LIBOR OIS spread, where MRR was, MRR is being replaced now instead of LIBOR. Clear? Again, I'll repeat common thing. Both the spread captures the risk in the banking sector, just that the benchmark, there is treasury, here it is OIS. Clear? Right? All the 5 spreads. This topic has this concept, very important, very high chance of that being asked in exam. Now, the last thing about the topic was the different types of term structure theory. Term structure theory, you had the unbiased expectation theory. So I'll write down the term structure theories. The term structure theories. So just for your reference, term structure theories, we need to know the name. Okay. And one single word is okay for you to understand that in the exam. You have unbiased expectation theory, or also called the pure expectation theory. Unbiased, or called as the pure expectation theory. Now, this is the first theory. What does the theory basically meant? The theory meant that when, first of all, why are we discussing these specific different types of theories? We are trying to understand what will be the shape of the yield curve. The yield curve will be upward sloping or not. So we are trying to understand whether the forward rates will they be higher than the spot rates or not. That is the objective here. In the unbiased expectation theory, we have the assumption of risk neutrality. Now, what is risk neutrality or risk neutral? Risk neutral is where the investors are not concerned with higher maturity and higher risk. Understood? So, the biggest principle here of risk neutrality means they don't require a risk premium for maturity. Risk neutrality means no risk premium for maturity. That is the concept of risk neutrality. So here, is this practical? Unbiased expectation theory. Do you think it is practical? Everyone? Is it practical? That there is no risk premium for maturity? We have seen the yield curves are upward sloping, right? So this theory itself is baseless. Okay, but just for your reference, unbiased or pure expectation theory assumes that investors are risk neutral. They don't require a premium for higher maturity. Of course, that is not practical. Therefore, you have the other theory, which is the local expectation theory. Local expectation theory. Now, what does this theory say and how is it different from the unbiased expectation theory? Local expectation theory, I'll also take you to the basically explanation here. It does preserve the risk neutrality, but only for short term. So yes, this also assumes risk neutrality, but only for short term. Yes. So notice here, it preserves only for short term. However, for longer period, it assumes there is a risk premium. So for longer maturities, there is a risk premium. But for shorter duration, it assumes the risk neutrality. So let's say 3 months, 6 months, 1 year, 2 year, there is a bit flat. And then for longer maturity, it might be slightly higher. Local expectation theory. Correct? It's not completely the solution, but a beginning compared to the pure expectation theory. The more important is the liquidity preference and segmented market theory. So I'll move to that. The liquidity preference theory. Liquidity preference theory. Then you have segmented market theory. Okay. And then you have preferred habitat theory, which is perhaps quite similar. This is preferred habitat theory. Okay. Now, you need to understand what is the minor difference between all of this from the theory point of view. They might probably ask you all of this in the theory. Now, the name liquidity preference theory means it asks for liquidity premium. So, compared to shorter maturity bonds, longer maturity bonds face liquidity issues, right? Of course, we are not talking about the government bonds. So they are saying that if the future rates are higher, that is perhaps due to a liquidity premium. Correct? So liquidity premium, if the liquidity premium is high, the yield curve will be positive sloped, positive slope. That is what is called the liquidity preference theory. Got it? But what is segmented market theory? Segmented market theory is that the yield shape is determined the preference of borrowers and lenders. Yes. So here we write the shape of yield curve is determined by the borrowers and lenders. That is the demand and the supply creators. What do you mean by that? Suppose if majority of the investors are by institutional investors like sovereign wealth fund or insurance companies, and they want a 30-year specific bond, then that specific maturity will have a higher yield. So the thing is that the yields are very importantly, yield at each maturity is not dependent on liquidity or any other reason, but it is independent of the maturity. So the most important thing about this theory is that it is independent of yields are independent of maturity. They are not dependent on the maturity. So higher maturity, higher risk is not always the case. This is completely different. So this is segmented market. It's completely based on demand and supply, right? Now, very minor difference between this and the preferred habitat. Preferred habitat also says the same thing, that the yield curves are dependent on the habitat of the buyers and the sellers. But there is one difference. There is one difference. The segmented market theory assumes that the yield curves are generally on they are if they are independent, their yields are independent of the yields at maturity, at other maturity. So here, what is the important thing? Yields are independent of maturity. So what happens is that a 5-year yield and a 6-year yield are completely independent. That is what we learned in the segmented market theory. But what is a preferred habitat theory? Minor difference. It also proposes that forward rate represents expected future plus a premium, but it does not support the view that this premium is directly related to maturity. So here there is going to be the premium, but premium is not related to maturity. So preferred habitat generally says that the yield will be premium, but not related to maturity. Okay. Minor difference between the both, otherwise they both are same. So can I say that the segmented market theory assumes that the yields will be always at premium, and the preferred habitat theory, the minor difference is that they are going to be based on the preferred habitat, but they cannot be always at much, they cannot always be at premium compared to the maturity. So here in the preferred habitat, there is a high chance that a 10-year bonds premium might be lesser than a 4-year bond. That is the difference between the segmented market theory and the preferred habitat theory. Understood, everyone? In segmented market, remember it is the demand and supply which derives the yield curve. Now, let me tell you something. When you go for the exam, they won't confuse you between segmented market and preferred habitat, because these two are actually the same thing. So whichever they give you, just remember both of them are based on the demand supply, not specifically on maturity. Now, when I teach it for the first time, students get confused between the two because they are almost similar. In exam, they don't do that. They will probably make it very clear. This is what I assume. They'll make it very clear. In fact, they'll compare this with the other theories. Clear? Right? Got it? Now, the last thing about this topic, which is actually my favorite thing, is the different shapes of the curve, which will tell you different strategies. So we are going to understand these different shapes. But before that, you need to understand the three factor. What are the three factors which affects the bonds, which is going to be very important for you from the point of view of understanding the yield curve. Yield curves are based on so what is this? This is basically decomposing the yield curve. So we are going to decompose the yield curve into the three factors. But what is the risk of the interest rate derived as? The risk is what we call as duration. Just remember, duration means sensitivity. It basically tells you the impact on the price of the bond due to the change in yield. Effective duration is what we use it for calculating option embedded bonds. Key rate duration, we are going to discuss it later. It is the duration. See, Macaulay duration, modified duration, effective duration, they all assume a parallel shift in the yield curve, means yield for all maturities increase or decrease by the same rate. But key rate duration focuses on a specific maturity, that how a specific maturity can distort the shape of the yield curve, which is also called the shaping risk. That's a non-parallel shift in the yield curve. Okay. Now, we are going to understand that change in the bond price is not only due to the sensitivity, that is, sensitivity basically is the increase or decrease in the rate, correct? A parallel shift or parallel increase or decrease in the rate actually is 90% of the change in the bond price is due to the increase or decrease in the yield curve, the parallel shift, which is called the level. So if I decompose the yield into three factors, the level is the parallel shift, steepness. Steepness means how the short-term and long-term bonds behave. So generally the yield is upward sloping. So the long-term yields are higher than the short-term. Am I correct? Now, when I say it becomes more steeper, means long-term yields are increasing or short-term yields are decreasing. Only then it becomes steeper. When will it become flatter? When short-term yields are increasing or long-term yields are falling. See, the yield curve is upward sloping. So only if the short-term yields increase or long-term yields fall, then it is flattening. This is called steepening. Steepening is concerned with the short-term and long-term. How do they behave? 90% of the bond change is due to the level, parallel shift. Then comes steepness and curvature. Curvature is basically how the short term, long term, and the mid term or intermediate behaves. If the short term and long term is high and the mid term is constant, if they increase, then it becomes more curve. You see this? The red one, where the long term and short term, right? If they increase further, it becomes curve compared to an intermediate bond. All three together will give me the change in the bond price. Understood, everyone? So I will write down here the three-factor model. Three factors. Three-factor model. What is this three-factor model? We are trying to understand what is going to cause the change in the bond price. Three-factor model for decomposing the yield curve. For decomposing the yield curve. Okay, so we are understanding the three-factor model. One is due to shape. Second is due to steepness. And third is due to curvature. Shape, steepness, and curvature. Shape means parallel shift in the yield curve. Steepness is the shift in the yield curve of short term and long term. And here, how short term and long term behave compared to the intermediate or midterm. You generally use the intermediate bonds. Okay, that is going to be the curvature. These three factors put together will give me the change in the bond price. So change in the price of the bond, which is also the percentage change. If I were to find percentage change in the price of the bond, correct? is due to the three factors. That is due to what we call as a parallel shift in the yield curve, due to the steepness, and due to the curvature. So basically we write duration. Duration is a sensitivity. Duration due to 1, 2, 3. This is duration due to curve level, steepness, and curvature. So you can write minus duration into what we do is that we find the change in XL. L is for the level, that is the shape, steepness, and curvature. Remember, all are negative because they go in the opposite direction. Yield and prices go in the opposite direction. So it's going to be the same thing. I will write down. You do not have to memorize this formula because I have rarely come across a situation where they are going to test all these formulas. All you need to know is that this is due to three reasons: level, steepness, and curvature. That is what will give you the change in the price of the bond. Got it, everyone? Clear? That's it. This is one of the formulas that you need to not remember, but just know that it is in the opposite side. Volatility. Remember one thing about volatility: yield volatility is higher for short-term bonds than for a longer-term bonds. So volatility is actually downward sloping. Understood? And now comes the very important point. As I said, how to basically use the information of monetary, fiscal, and bond related information from the market and how to trade based on that. Tell me one thing: the monetary policy determines or has an influence on which rate, short term or long term rates? Monetary policies. Monetary policies have impact on the short term or long term rates? Short term rates, correct? Now, based on that, we will see different angles. These are the four things that you should be aware about. Very interesting. You have your bullish. Whenever you hear the word bullish, what do you mean by bullish in the bonds? Means the yields are increasing or decreasing? Whenever you think about bullish in the bond, in bond, bullish is when the prices go up, that is when the yields go down. Yields go down, 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 right? So when you notice your bullish steepening and bullish steepening. Now, this is where I discussed in the class, you need to understand the shape is normally upward sloping. But when I say bullish steepening, means it will further steepen. This steepening, this steepening will happen. Bullish steepening means it's a positive thing. This happens when the short-term yields go down. The bond will be much more steeper. But it's steepening because the long-term yields are rising, the long-term yields are falling. If the steepening is because of the long-term yields are falling, steepening is because of the long-term yields are falling, can it steepen? No, it will rather become flat. So let me revise here. Normally the yield curve is where short-term yields are low, the long-term yields are high, correct? But when I say bullish steepening, it is steepening more. Steepening more here means the short-term yields are falling further. This is when the monetary policy has decided to reduce the rates to boost the economy. To basically, it's a sign of an expansionary monetary policy. So it's a positive sign. So bullish steepening is considered as a positive sign. Remember, if the short-term bonds yields are going to go down, it's better to buy them. Correct? But if you look at the other side, bullish flattening. Bullish flattening is where the yield curve is upward sloping, yes, but flattening is happening not because the short-term yields are rising. If short-term yields are rising, it's not a bullish sign, right? It's because the long-term yields are falling. Long-term yields are falling. Long-term yields are falling. That's basically due to flight to safety. Whenever there is flight to safety or long-term yields start falling. Now, of course, if you are buying long-term bonds, it's a benefit for you. So bullish flattening or bullish steepening. Here your focus is that, of course, the rates are falling, but which rate is falling? Short term, when it is bullish steepening, Bullish steepening is short term, but bullish flattening is when the long term rates are going down. When it comes to bearish, whenever you see the word bearish, bearish is associated with the yields increasing. Got it? So I can draw a continuum of what we basically see different angles here. So let me connect it. Whenever you see, first of all, we have short term and long term rates. So short term and long term rates. And here we have four different scenarios: bullish steepening, bullish, I will write here, steepening and flattening. And when it comes to bearish, I will say the same thing: steepening and flattening. Okay. Now, whenever I say the word bullish, bullish means the rates are always expected to go. Bullish in bonds is when you are expecting the rates to, yes, when you're expecting the rates to go down. Okay. But which rate am I expecting to go down? That is important. Okay. So see, when I say bullish steepening, yes, bullish steepening is for short term. Correct? Bullish steepening is for short term. So which rates are going down? Short term rates will go down when I say bullish steepening, but bullish flattening means rates are going down, but long term rates are going down. Bearish flattening means rates are going up. Now see, bearish flattening, it's a negative sign. So if I say bearish means a negative sign. So bearish flattening means normally the yield curve is like this. Bearish flattening means the short-term rates are increasing. So here the short-term bearish flattening is when short-term rates are increasing. But when I say steepening means what is going to happen here? In this case, the long-term rates are rising further. So rates are rising, but which rates are rising, guys? Sorry, my mistake here. Did I do something wrong? Yes, the long-term rates are rising. Correct, everyone? Understood? I'll repeat again. See here, when I say bullish steepening means the rates are falling. Which rates are falling? Short-term rates are falling. When I say bullish flattening means, of course, rates are falling, but which rates are falling? Long-term rates are falling. When I say bearish, rates are rising. So which rates are rising? Bearish steepening. I actually wrote it in a wrong column. Bearish steepening. Bearish steepening means which rates are increasing? Bearish steepening. It's a bear and it's becoming steeper. Long-term rates, when I say bearish steepening means long-term rates are rising. When I say bearish flattening means short-term rates are rising. Now I think I've written correct. Understood, everyone? Clear? Perfect. Any doubt in this? Everyone? Just focus on the term that short-term rates are determined by the central bank. So they are due to the monetary policy. So they are due to the action of the monetary policy. Correct? So if the short-term rates are increasing or decreasing, that's because the monetary policy is expansionary or contractionary. Clear? Everyone? Right? Then there was another thing called a bullet portfolio and a barbell portfolio. What is a bullet portfolio and a barbell portfolio? First of all, when majority of your investment in bond is concentrated to a specific maturity. So your bond concentration, when it is to a specific maturity. So bullet portfolio is basically when majority of your bonds are located at the specific maturity, right? So that's a bullet portfolio. A portfolio which is concentrated at a single maturity. So concentrated at a single maturity. That is a bullet portfolio. Contrary to this, what is a barbell portfolio, which is spread across short term and long term? So barbell portfolio is not concentrated at a single maturity. It's a portfolio with different types of maturity. So portfolio of consists of short term and long term maturities. Short term and long term maturity bonds. Okay. Now, of course, a bullet portfolio is relatively riskier compared to a barbell portfolio. Okay. Now my bullet and barbell looks similar. Barbell portfolio. Okay. Now, which one should I go for and in what situation? See, understand this, that investors with only long mandates means they cannot do short selling, correct? May rotate between a bullet portfolio. They will keep on shifting the portfolio. But those who do not have such a mandate, they can buy and sell. They can buy and sell. So if an investor expects bullish flattening, what is bullish flattening? Bullish and flattening means long-term yields will go down, isn't it? So guys, I should be investing in the long-term yields because their price will rise, correct? So in that case, I should rotate from which portfolio to which portfolio? Barbell to bullet or bullet to barbell? I should move from bullet to barbell A or barbell to bullet B. Yes, I should move from a bullet strategy to a barbell strategy when the yields are expected to change. Clear? So I might probably be buying long-term bonds because their yields are expected to go down, and I can also sell short-term bonds. Correct? That is if I have a long and short both available. I'm not only a long portfolio, I can also do short. So you will rotate between a bullet and a barbell strategy when you're expecting yields to be flattening or steepening. Clear? Everyone? Okay, correct. Very important. So much of information in your first topic itself, right? Now, as I said, the first three topics are interconnected. So if you look at the second topic is going to discuss about the binomial tree. And the third topic is also similar, but for a callable and a puttable bond. Got it? Now, how to find the binomial tree or arbitrage-free valuation of a bond? First of all, the word arbitrage means you are going to compare the bond and see, there is a possibility of arbitrage. How will I know that? When I compare the bonds, right? So at the beginning of the arbitrage valuation, we actually did two types of arbitrage opportunity. One was value additivity, right? This was value additivity. What is value additivity? Value additivity is where the sum is compared to the whole. Correct? So multiple bonds are compared to a whole bond, right? Of a similar feature, identical feature. But when I say reconstitution or stripping, in that case, this the second opportunity, one is what we discussed here is value additivity. And in the second case, which is where we will look at which one is the dominant bond. So there we don't do the sum or that. We just compare the two bonds of similar pricing or identical features, and then we will compare which bond is under and overvalued or which bond dominates over the other. Got it? Now, based on that, you can do the arbitrage. You can practice those questions pretty much straightforward. You will have to make sure that in the arbitrage, the principle is that the beginning investment has to be zero and there has to be a certain gain. Correct? Now, more than this, the important thing is the binomial interest tree of concept, which is about the bootstrapping. Here we are going to derive the interest rates and the value of the bond using the concept of this binomial pricing. Okay, here nodes are very important. So we are going to do the backward induction using the binomial model. Correct. So first in this topic, we are going to value an option free bonds using the nodes that they give us, right? We are going to do the backward induction process. Two important principles under the binomial backward induction process, which now I'm going to write down in the formula. By the way, we've now moved to the reading number 2. This reading focuses on the arbitrage-free valuation framework. So reading 2, arbitrage-free valuation. Okay. I'll repeat, 2 and 3 are quite similar. Got it? There's no complicated things under 2 and 3. Some of the important principles I'm going to write down, including arbitrage free and all. Number 1, in arbitrage, we have certain gain, certain risk-free gain, correct? Second principle that we are going to discuss is about the backward induction in binomial. In binomial, there are two possibilities. There are two possibilities. And what is the probability of each? Probability of upside and probability of downside is what by default we assume as 0.4 equal possibilities. Isn't it? Clear? The upside and downside. How dominance differs from additivity? Okay, my friend is asking me a question. Dominance and additivity. See, let me go back here. You can see the example in the value added additivity. You'll have to buy 10 bonds of A to make it comparable with B. But in dominance, you don't have to do that. You have these two bonds of same price and you'll have to compare which one is going to give you higher value. Understood the difference? Clear? In value additivity, you'll have to combine the sum and compare it with the another big bond, right? So basically, you're going to combine. In dominance, you don't need to do that, right? Doesn't make any big difference in order to do the arbitrage. You'll just compare the overall investment value has to be same at the beginning and at the end, correct? Now, in the binomial, going back to the binomial, we discussed the principle that there are only two possibilities, upside and downside. Binomial means upside and downside. The possibility of upside and downside is the same, correct? We are going to do backward induction valuation using the principle of backward induction. Now, what is backward induction or backward induction, which we will discuss? Backward induction, where we will require the bonds cash flows and spot forward rates, especially the forward rates to first spot rate and the relevant forward rates to bring the bonds present value. But one more thing I require is to find this spot and forward rates at two different nodes. I will need the standard deviations, right? So standard deviation between the two nodes is actually derived using a exponential factor of 2 standard deviation. 2 into standard deviation. So if I have interest rates after 1 year upside and interest rate after 1 year lower, upside and lower, how do I go from low to high? From low to high, to go from low to high, I need to multiply with e to the power of 2 standard deviation. Then the volatility between the interest rate is 2 standard deviations. Through this, you can find the interest rates. If you have the upside interest rate, you can find the downside interest rate and so on. Clear, everyone? We will see that when we do the examples here. So if you want to see, it is 2 standard deviation. The difference between the two nodes is 2 standard deviation. But if you're seeing the difference between the 3 node, which I'll show the 3 nodes, when you want to go from the difference between these two nodes, if you check, this is of 2 standard deviation. Let me show you that. 2 standard deviation. Where is it? Let us see some example where we've been provided with the standard deviation of 20%. So in this case, since the standard deviation is provided to me, if I have 5.77, I can go to 3.88 by dividing by the E of 2 standard deviation, or you can multiply with E negative, or you can multiply 3.88 with the 2 standard deviation and get the 5 point. But if you want to go from this node to 2 nodes up, you will have to do E to the standard deviation twice. Understood? So that is basically 4 standard deviation. Okay. Now don't worry about this. When I'm sure you will practice, you will realize this. It is pretty much easier. In exam maximum, they will go for a 3-year bond or rarely in fact 3-year bond. Mostly they go for a 2-year bond. So in exam, most of the time you will see a 2-year bond situation similar to this. So let me take up an example of how to value an option-free bond considering all the scenarios. Here we have a 3-year bond, but a 2-year bond example, if you see here, we have the interest rates. They may make us the interest rate missing. We can easily find the interest rate using the e to the power 2 standard deviation. Clear? Now, once I get this, I have the spot rate, correct? I have the 1-year rates now, the 1-year forward rates. These are my forward rates, correct? Between the two time phrases, I can get the rates. But how do I find time two rates? To find the time to rate in the middle, you need to use the spot forward concept. So again, to find the spot rate in the middle, 1-year forward after 2 years. This is 1 year forward at time 2 after 2 years. To find this, you require, if you notice the timeline stuff that we did, to find this particular point, you require a 2-year spot rate and a 3-year spot rate. Got it? So did we have 2-year spot rate? Yes, we had a 2-year spot rate. What was a 2-year spot rate? We had here a 2-year spot rate and we had 1-year spot rate. From that, we can find F11. But if I have 2-year spot rate and 3-year spot rate, so from this, I can get 1-year forward after 2 years. So 4.02 and 5.09, these will help me with finding the forward rates in the middle. So once I get the middle rate, then I can find the adjacent rate. See, check here. Once you get the middle rate, you can find the adjacent rate with 2 standard deviation, upside and downside, upside and downside. Got it? Multiply or divide to find the adjacent rates. Once you get the adjacent rates, then you need to pull all the bonds cash flow to the present value. So to give you an example here, let's say the bonds present value, these are a typical bond with the present value. Let's say a 2-year bond. Where is the situation? Let me show you this. This is a 2-year bond, correct? On maturity, it will be me par plus coupon. If on maturity, the amount is fixed, there are two situations here to find the value. We will first find the value when the interest rates are up after a year and value when the interest rates are down after a year. Remember, the probability for both the situation is 0.5, 0.5. So you can actually add the value and divide it by 2. Doesn't make any difference if the answer is the same. So 0.5 into 0.5, you bring it to the present, add the discounting rate, forward discounting rates. Understood? Then these plus coupon, you bring it back at the spot rate to find the V0. Now, I'm not going to do the calculation here because I will show you the calculation of how exactly the same process is repeated if it's a forward, if it's an option embedded bond also. In option embedded bond, also we are going to do the same thing. So actually, now, how do you save time in fixed income? On this same concept, entire this topic and in fact half of the next topic is dependent on this. Majority of both the topics are dependent on this part. Okay, so when we do the vignettes, we will also see the questions related to that. So these are the different angles that you see. The valuation that you get at each node, you need to bring it to the back. We will see that in the case study how this is done. And this is how different paths are created. So these are different paths. What is different path? See, this is a path 1 where first the spot rate is 3%, then this and then this. This is path 1. path 2, path 3. Path 3 actually is eventually going to here, and path 4. So basically there are 4 paths in a 2-year bond. Understood, everyone? So there are 4 paths. Clear? If it's a 3-year bond, there will be more paths. Okay. Path basically tells you that what will be the situation when the interest rate goes in these directions. Now, this is suitable for an option-free bond. But what is the situation for an option-free bond? They are not dependent on the path. However, option embedded bonds, especially like mortgages are dependent on the path. Why? What is the discussion that we are supposed to do here? That mortgages, it does matter where the interest rates are going on. Suppose if the interest rates are first falling, then a lot of people will prepay the mortgages. But when it falls for the second time, the prepayment might not be as high because most of them must have done the prepayments earlier. So the fall in the interest rate or the rise in the interest rate is important, but from which path it is coming, that is more important. Now, related to this, I just want to discuss here about the path, maybe asked in your theory. An important assumption of binomial is the process that the value of the cash flow is independent of the path. So it's not path dependent, correct? But a mortgage-backed security, the thing with mortgage-backed security is that they are path dependent. Path dependent means their cash flow situations will change based on the direction of the interest rates. So their path will not be consistent. They are path dependent, and therefore you need to adjust for this, which is what we call as a drift adjustment, which is called the calibration process. Now it is very difficult to do manually, so we use the Monte Carlo simulation where we actually see multiple angles. So you will see multiple angles. This is not possible manually, so we use the help of Monte Carlo simulation to process it. Now the backward induction that you did in this topic and in the next topic, it is quite similar. So before I show you the interest rate models, which we discuss later on after doing QM, these interest rate models, before that, let me actually connect the third readings valuation, because it's exactly the same thing. So in this reading, what we are also going to do is we are later on going to do the term structures. But what is crucial here in this reading is that before this, we need to understand that in the next reading, also the process is same. The valuation process is same, but just one difference in the nodes is the impact of call and put, or callable and putable feature, which I need to discuss. Understood? So now what will we do, that instead of continuing with this, we'll rather go to reading number 3, which is about valuing of the bonds with embedded option. So now I'm going to go to reading number 3, and then we'll come back to reading number 2 for doing those models. So reading number 3 is basically valuation of bonds with embedded option, basically callable, putable, and convertible bonds. Okay. I expect in exam backward induction, bootstrapping using the option embedded, because it is the same thing as for option free bonds, but minor difference. Basically adjusting the cash flows for the call price or the put price. So we will first do this embedded option bonds. Understood, everyone? And then we'll go to the term structure models. All right. Okay. So let us start with the valuation using embedded option. Now, when it comes to embedded option, remember there are simple options, callable and putable, which we all know. Complex option, you don't have a calculation related to complex option, but complex option are estate put. Estate put is basically here you allow your successors, that is the heirs, to transfer the amount, right? When you transfer the estate, correct? So put is here, the estate put includes a provision that, in US there is an estate tax. So what is the provision here? It allows the heirs of an investor to put the bond back to the issuer upon the death of the investors. Why? Because you are in need of money. It's like a put option. Sinking fund is where you retire the bond in a sequence. These two don't have a calculation, so you should not be worried about that. Correct? They just have an information. Now the focus is going to be on the callable and puttable bonds. Now, before that, you need to understand that callable bond is good from the point of view of issuer, not for the investor, and puttable is good from the point of view of investor because they can sell the bond and get the par value. So when we compare all the three bonds, which bonds valuation is always higher? Value of callable bond is relatively lower, right? Value of callable, value of callable bond, puttable bond, and option free bond, which is also called straight bond. So value of straight bond, straight bond. Amongst the three, whose value is always higher? Value of puttable bond is higher than straight bond, which is higher than a callable bond. Correct? So therefore, it is very easy for you to understand that value of a callable bond and value of a puttable bond that you can compare with a straight bond. Okay. So straight bond, whether it will be plus or minus. So compared to a straight bond, the callable bond's value is less. So it will be less the value of call option. And for put option, value of put option, now compared to an option free bond, puttable bonds value is higher. So we add. Is this clear, everyone? Got it? Right? Check, 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 check. Yes. Okay, the same thing. Now, when it comes to backward induction, we need to always understand that we are going to follow the same process as we did for a straight bond. But if it's a callable bond, whenever the bond price goes up, the maximum you will get is call. So here, if you notice, whenever the bond price goes up, the maximum you will get is 100 because the issuer will call back. So instead of taking 101, we will take 100. And in puttable bond, what happens is that we take the minimum price that you will get is 100. So whenever the value goes below 100, if it's a puttable bond, here you will at least get 100 if it's a puttable bond. This is very crucial and this is highly tested up in exam. So conclusion, if you notice, you will see the same scenario that relatively the option free bond and the callable bond's value is low. The difference is the value of the call or the put. Clear? This is very, very, very highly tested in exam. Got it? Now, from the risk point of view, you need to understand that what happens from the derivatives. We in fact learn in derivatives that volatility is friend of option. So when volatility increases, what happens? When volatility increases, guys, the value of call and put both will increase, isn't it? Isn't it? So the value of call and put will both will increase, but increase in the value of call option is a bad thing for a callable bond because callable bonds value will fall. So when I say volatility increases, value of call and put both will increase, but increasing the value of the call is a bad sign for a callable bond. So callable bonds value falls. Got it? So I will write here, even though we have written much detail in later on. So whenever the volatility increases, volatility being friend of option, what happens is that value of call and value of put option, they both will increase. But value of call option increase will lead to value of callable bond and value of puttable bond. See, value of call increase, is it a good sign? No, it's a bad sign. It's a bad sign for a callable bond holder. It's good for the issuer. So in this case, value of callable bond will fall, but for value of put increases means value of puttable bond will increase. Are you with me on this? Correct, everyone? Now, when it comes to the shape, here we are going to discuss about the yield curve. If the yield curve is upward sloping means the yields are rising. If the yields are rising, a callable bond will be called when the yields are rising, or it will not be called. See, a callable bond is called when the yes, tell me, the callable bond is called when the yields are falling. So if the yield curve is upward sloping, the value of call is going down, which is a good news, right? If the yield curve is upward sloping, yes, see here, if the yield curve is upward sloping, in this case, what will happen? If in this case, when the yield curve is upward sloping, value of call will be low because upward sloping means the chance of bond being called are less. Clear, everyone? Right? But if the yields are downward sloping, then what happens? We've discussed that, if the yield is upward sloping or if it is downward sloping in the sense, it means the yield curve is becoming flatter, means the long-term rates are dropping. So if the rates are expected to fall, the chance of bond being called are higher. So value of call option increases. Also, if the rates are increasing, the put becomes more valuable because the bond prices are falling. Understood? What happens due to the change in the volatility, change in the shape or the level of interest rates? Correct? Interest rates, volatility increases, the value of the call and put increases. For call, it backfires. For put, it is going to be a benefit. Shape, upward sloping is not good for puttable bond because upward sloping is not good for the value of a callable bond, the value of puts. Sorry, my mistake. Upward sloping yield curve. See, the value of the option and the value of bond are two confusing things. When I say the yield curve is upward sloping, value of call will fall and the value of put will rise. Both are good news for investors. Investors, both are good for bondholders. Why? Because callable bond will not be called, right? And put will be in the money. Clear? So what will happen? I will at least get the par value, right? In on the other end, when the yield curve becomes flatter, what happens? The value of call option increases. That means the chance of bond being called back are higher. And the put is not in the money. The put is out of the money. So it doesn't benefit. Understood? What is the difference here? Shape and the level of interest. How does it affect the call and the put? Clear? Now, when we invest, do we look at the Z spread for a callable bond? No, we look at which spread? OAS, option adjusted spread. What is option adjusted spread? So from the Z spread, from the overall spread, if I adjust for the option or the call risk, that the balance spread is what we call as OAS. So OAS is nothing but the difference between the Z spread and the call risk or the option risk in the bond. Clear? So I will write down here OAS. OS. How do I find the OAS? OS is nothing but the Z spread minus the option value or option risk in the bond. So the difference between both is called the OAS. Whenever we are evaluating option embedded bond, we always look at the OS. Now, if this OS is too high or too low compared to the peers, that's where you can make a decision whether to invest in the bond or not. If you think that the relative OS that they have given is too high compared to the peers, that means the spreads will go down, assuming the risk is the same. So if your OS of your bond is higher than the market, then the spreads will go down. So it's an opportunity for you to invest. So it's undervalued. But if your OS is relatively low, then the spreads will increase. So bonds value will fall. So it is overvalued. Remember this, higher spread compared to the market, the spreads will fall, mean reverting. So that's a good news. So you should buy the bond if the spreads are expected to fall. Clear, everyone? Got it? Okay. Here I have discussed that If the volatility increases, what happens? We already discussed that the value of call and put both goes up. Callable bond, if you are a callable bond holder, right? If the volatility increases, that's a bad sign because the chance of bond being called are higher, right? So you will lose the money in that case. So the value of callable bond will fall, but the puttable bond will increase. Understood? Now, when it comes to option adjusted spread, what happens when I consider volatility and the spread? So here, volatility and spread, option adjusted spread is the risk. So higher the volatility, what happens for a callable bond and puttable bond? In callable bond, my bond's chances of being called are, see, in both the cases, the bond chances of being called are higher, correct? But when the volatility is too high, why is that the OS of a callable bond will fall? Option adjusted spread of a callable bond will fall. And for a puttable bond, we've written it will increase. Check here, everyone, in our notes with respect to volatility. See here, where is it? Level of interest rate shapes. Yep. See this. Option values are positively related to volatility. As I said, it's friend of option. The value of straight bond is affected by the changes. Fine. When the interest rate volatility increases, value of callable bond, as we discussed, decreases and the value of puttable bond increases. Simple, right? So volatility will, how it will affect the bond price, we discuss. But what about the spread? What about the option adjusted spread? Where did we discuss about the spreads? So here we will go to the discussion about the spread. Yes. Okay. See this. Here, the difference between the bond from a tree. So here, greater the difference, the greater the OAS, greater is the spread. Now, if I assume a volatility of 15 percentage or 20 percentage, then what will happen? The chances of the price deviation is too high. Whenever we increase the assumption of volatility, the chances of bonds getting in the money are higher for both the bonds. Correct? So higher volatility will eventually what? Eventually will do what? When we use a higher estimate of the volatility, the call option value increases, the put option value also increases. Correct? But when call option value increases, the value of callable bond goes down. Now, when I say when the value of callable bond goes down, when your value of the bond goes down, so what is the issue related to that? So see this, the price of the callable bond decreases, hence the estimated volatility, the computed value of callable bond is more close to the market price. Understood? The bond will be, see, callable bonds yields are higher. So what will happen now? Because of the volatility, they become closer to the market value because there is a chance of bond being the option being in the money. So they are more closer to the market price. When they are more closer to the price, what will happen? Their OAS, option adjusted spread, will fall. When the bond becomes more closer to the market price, is its OAS falls. Correct? So instead of getting confused here, all you need to summarize is that when the volatility increases for a callable bond, right, its OS becomes low. And the same for the puttable bond, its option adjusted spread increases. Clear? Right? Okay. Now we have to discuss about the different types of duration. Duration. First of all, what are the durations of the bond? Duration is a sensitivity or the risk of the bond. Correct? Now, remember for option embedded bonds, we look at which duration? Effective duration, not at modified Macaulay or any other duration, effective duration, which considers parallel shift in the yield curve. So effective duration can actually also be used for straight bonds, but it is more suitable for option embedded bonds. Now, before we go into the duration and convexity, right, just to remember the basic concept of duration, For zero coupon bond, the duration is generally equal to maturity. For coupon bearing bond, it is less than maturity. Callable and puttable bonds is below the straight bond because they have the chances of being called before the straight bonds, right? Or they have been the chances of being exercised before the straight bond. So their duration is always lesser than the identical straight bond. Floating rate bond, all of these are fixed bond. Floating rate bonds duration is not equal to maturity. It is equal to the reset period. What is a reset period? Reset period is the period when the bonds pay the coupon. So if it's a semi-annual bond, its duration is half, that is 0.5. Correct, everyone? Now, all of these durations are fine. Actually, one very important duration that we need to consider here is the key rate duration. What is a key rate duration? Key rate duration is a duration of a specific maturity, correct? Which is also called one-sided duration. One-sided duration means the duration on upside and downside is not the same. For example, for a callable bond, when the interest rates increase or decreases, the reaction of the duration is different. Okay. So one very important thing is this diagram. So when the interest rate rise, the chances of calling are lesser, but when the interest rate falls, the chances of calling are higher. So now we are looking at the key rate duration or one-sided duration. So key rate or one-sided duration. In this case, we are going to look out at what is the impact on a callable and puttable bond. Callable and puttable bond due to the increase or decrease in interest rates. Due to the increase or decrease in interest rates. So if the interest rates goes up or down. So if the interest rate goes up, whose chances of exercising are higher? So what will be the effect on effective duration? So basically, this is what I'm writing. What will happen to effective duration? Effective duration if the interest rate goes up or down. Yes. So if the interest rates are high, whose chances of being called are higher? Puttable bond. So puttable bonds duration will shrink, isn't it? So when interest rates are high, puttable bonds effective duration will go down. But when interest rates are low, callable bonds effective duration will go down. Understood? Opposite will happen when interest rates are not in the same line. So callable bonds actually effective duration is higher when interest rates are going to increase. So here the effective duration will increase. Here puttable bond effective duration will increase when the interest rates are lower. Understood, everyone? Right? This is called one-sided duration. How is going to be the effect is not the same on the upside and downside for callable and puttable bond. This is very important. So one-sided duration is how the price will react on the upside and downside. So for a callable and puttable bond, when I say one-sided duration, means the change will be higher or lower. For callable bonds, when the interest rates increase, the upside change is the fall on the upside is going to be pretty much normal. But when the interest rate decrease, sorry, when the interest rate increase, the downside is going to be normal. The downside the fall in the price of the bond. But for a callable bond, what happens is that in a callable bond, when the interest rates fall, when the interest rates fall, the chance that normally when interest rates fall, the bond prices should increase, but the change in price is going to be less because the issuer will call back. Same way in a puttable bond, normally when interest rates increase, the bond price falls. But for a puttable bond, the fall will be less. Why? Because you have the opportunity to dump the bond. So the change in price will be higher or lower on a callable or a puttable bond when the interest rates increase or decrease. So when the interest rates increase or decrease, we discuss what will happen to effective duration, correct? But what about the change in price? So if I were to, along with that, understand what will happen to change in price in the same one, so let me also tell you what will happen to the change in price. So for a callable, now I will write what will happen to change in price. Change in price will be higher or lower, more or less. Change in price will be more or less relatively. Okay. So that is what we are going to write. Okay. So again, for a callable bond, we can test it here. For a callable bond, when interest rates decrease, this is the downside one. The chances of bond being called are higher. When I say the chances of bond being called are higher, so what will happen? The rise, which was supposed to happen, will happen less. So whenever the interest rates increase, the change in price, and whenever the interest rate decrease, the change in price is different. For callable bond, whenever interest rates decrease, the change in price will be not as high. So it will be less. Understood? Compared to what it should be, here it will be more or higher. Same way in puttable bonds, I can say about the puttable bonds. This is callable bond. This is about effective duration. I will write this is about effective duration. Okay. Now, for a puttable bond, normally when the yields increase, the price of the bond will fall by a high rate. But for a puttable bond, that change in price will be less when the interest rate goes up. So when the interest rate goes up, the change in the price for a puttable bond will be less. That's a good news. Otherwise, it will be more. This is all you need to understand about key rate or one-sided duration from your exam point of view. Clear, 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 clear. Okay. Rest of the information you can just go through it. No need of making it more complicated. Then later on, like callable and puttable bond, remember callable and puttable bond have, they have a fixed rate for a particular duration. But a combination of multiple callable bond is called cap, and a combination of multiple bonds is a multiple put bonds is called floor. So cap and floor are nothing but the extended version of a callable and a puttable bond. So what is a cap floater? Cap floater contains an issuer option that prevents coupon rate from increasing beyond a point. Floor is what will make sure that the coupon rates won't fall. So cap is good if you are a borrower. You don't want the rates to rise. Put or floor is good if you are an investor or a lender. You don't want the rates to fall. Got it? The rest, the valuation is same as what you had for a callable and puttable bond. All you need to do is replace the call and put with the cap and floor, cap rate and a floor rate, right? Otherwise, there is no difference. Exactly everything is the same. Clear? Okay. Now, this topic has a plethora of formulas related to convertible bond. So, here, most of the discussion that we did till now was for non-convertible bond, for option embedded bonds. Now, for convertible bonds, I will directly go to the formula and explain all the concepts one by one. First of all, convertible bond is a bond which will be converted into common equity at some point of time in the future. So the rate at which it will be converted is called conversion ratio. Conversion ratio is basically how many number of equity shares you will get for each bond. But when will this conversion happen? When it reaches the conversion price. So conversion price is basically the bond's price, issue price, divided by the conversion ratio. So for example, let's say the conversion ratio is 25, and the issue price of the bond is 1000. So 1000 divided by 25 until the market price of the bond reaches 40. Let's say 1000 divided by the conversion ratio, suppose it's 25. So until the bond's price reach 40, until the market price of the stock reaches 40, the bond will not be converted. This is called conversion price. Everyone, right? Conversion value is the value that I will receive when I get those shares and I sell those shares in the market. So let's say I'll get 25 shares, and if I sell all the shares in the market at $100, that's my conversion value. Straight value. The biggest advantage of buying a convertible bond is the straight value. Straight value is the minimum value in the bond. Assuming the bond was not convertible, what is the minimum value that I will get on the bond, which is nothing but the present value of the future cash flow. So in a bond, you will at least get the straight value or the conversion value, whichever is higher. So the lowest you will get is the straight value. So minimum value of a convertible bond is whichever is higher of both. Straight value is the bare minimum you will get, or conversion value. But remember, these types of bond, you actually buy it at a premium. So now, along with straight value, I will actually discuss this downside risk in these bonds. What is the downside risk in this bond? Downside risk is the risk that the bond's value, the lowest you will get is straight value. There is no risk below that, right? The bond will at least fetch you this. So what is the price of the bond? Let's say you bought the bond here. Let's say in this case, you bought this bond at a market price of 985, correct? But the straight value of the bond is 950. So from 985, all the way it can fall to 950. So there's a $35 loss from the top. So 35 from the top, that is the downside risk. You will not face risk beyond that. So whatever is the market price from the straight value, that is your downside risk, which is also called premium over the straight value. So here, what is my straight value? 950, correct? And the market price is 985. So 985 divided by 950 minus 1 into 100, that approximately roughly 3.8 percentage, the 3.68 percentage was your downside risk. So if you notice here also, where is it? The downside risk or the premium is 3.68. Means what? The fall from the top will be not more than 3.68 percentage compared to the straight value. Got it? Right? Now, that is straight value, the bare minimum that you will get on the bond. The maximum, you are investing in the bond so that you get a conversion value which is higher. So when you sell the bond in the market, when you convert the bond, sorry, when you convert the bond in equity and then sell those equity in the market, you will get more than what you invested in the bond. That is the entire intention behind investing in such bonds, correct? So that is the conversion value, which is what you are waiting for. Now remember here, if you directly bought the stock, you would have bought it at the market price. But since you bought this bond, convertible bond, you have a dual benefit. Until conversion, you get interest rate, and after conversion, you might get a higher value. So that's why you are paying the premium on such bonds. That premium, we are going to calculate those premiums, correct? But before that, when you are investing in such bonds, this premium need to be recovered. So what is going to be my break-even point? Break-even? Market conversion premium in dollar and in percentage. These are the two things. So break-even point of a stock. Here we are trying to find break-even point of a stock. Now, what is the break-even point of a stock? Here, break-even point is the market conversion price, which is market price of the convertible bond divided by the conversion ratio. Suppose you bought the bond at 985 and you're going to get 25 shares. So until the share reaches a specific point of, I got the answer of 39.4, until that you won't break even, because until that point you will just recover your value. So until your conversion value reaches till this point, you will not recover the amount. That is called break-even point of a stock, or called as market conversion price. Let me show you what is market conversion price. See here. Market conversion price. Market conversion price is we bought the bond at 985 and the conversion ratio was 25. So until the stock reaches 39.4, I will not break even, right? Right now, the stock is available, the stock is available at a price of 35, but your break even is 39.4. So the extra 4.4 in terms of dollar is your conversion premium. So whatever is the market price of the stock and how much is your conversion price, the difference between both in terms of dollar is your conversion premium, and you can also find that in percentage. So you can take your market price divide by the market price of the stock, current market price of the stock. When you just do that in a ratio, it's a conversion percent premium percentage, right? So the extra that you paid, 4.4 over and above 35, the current market price, that in percentage is your conversion premium ratio. Clear, everyone? After that, you need to understand that how to value the bonds with conversion and callable and puttable feature. Very interesting. So remember, having a convertible bond is an advantage. Having a puttable bond is an advantage, but having a call feature is a disadvantage. So compare it with a straight bond. So what is an option-free bond? Option-free bond is the value of a straight bond, correct? Option-free bond. Now, whenever you are buying an option-free bond, it's simple to buying a normal straight bond. But when you're buying a convertible bond, it is not only buying an option free bond, but you're buying also, you know, when you have a conversion option, you're betting on the increase in the stock price, which is as similar to buying a call on equity. Why do I say call on equity? Because you don't lose when the value goes down, because you will at least get the straight value. So conversion feature is like having a long call on stock, correct? Right? Now, in this, what if the value of the option free bond, if we add the call feature? So here, which is a straight bond, correct? Plus value of call on the stock, that is for convertible bonds, correct? But now if this is the normal valuation, right? If I add the callable feature to it, so is having a callable feature an advantage or a disadvantage? It's a disadvantage. So what happens here, when I add a callable feature, it's minus value of call option. But if I add a puttable feature, it's plus the value of put option. Understood, everyone? So convertible bond, when you buy a convertible bond, it has two things, a long bond and long on the stock, correct? Long call on the stock, right? But along with that, if you add a callable bond, it's like negative value of call option. Puttable bond, positive value of put option. Clear? So a bond which is inclusive of all is a callable and puttable convertible bond. A bond which is callable, puttable, and convertible. So it is equal to straight value plus value of long call on a stock minus value of call option on the bond, correct? Plus value of put option on the bond. Four things that includes all. Understood, everyone? Clear? Right? That's the end of this giant topic. And this is where all the three topics are interconnected. Reading one, two, three. Now, what we were supposed to do is that we were supposed to understand one more thing is in the arbitrage free valuation, the different type of term structure models. Now, what are the term structure models? Term structure, so basically we used, different types of model to predict the term structure of the interest rates. Here we use some important information related to quants where we use these two models. Now, what I would want to show you from the exam point of view, you don't have to memorize the model. All you need to understand that there are three types of term structure models: equilibrium, arbitrage, and multi-factor. Equilibrium, I will write down here. equilibrium models, arbitrage-free models, both are single factor models. These both are single factor models. And then Gauss plus is a only one, which is the multi-factor model. Again, we are doing these models to forecast the term structure of the rates, correct? Now in exam, generally they ask you what is the difference. Okay. So now let me point out what is the difference. Of course, we have that in the notes. So I will also go to the notes for you all to highlight basically what we did. So this is basically in the arbitrage free valuation where we discussed these 5 types of model. Again, it is going to be asked in the exam from the theoretical point of view. Okay. So let me go to that point. Yes. Equilibrium term structure models are dependent on the fundamental macroeconomic variables and so on. So they are dependent on the fundamentals. Now, again, they can rely on multiple factors, right? But the models are single factor model. So it can be any factor, but these are single factor models. Arbitrage free is also the next one, which we are going to see. Arbitrage free is also single factor model. But the biggest difference between these two models, the equilibrium term structure and arbitrage, is the understanding of the mean reversion. Mean reversion. Yes. Within the term structure, you have Cox-Ingersoll model and Vasicek model. Both are single factors. The only difference that you see in the formula, which you need to remember from the exam, is here about the standard deviation of R is missing in the Vasicek model. Why is that so? Because in the Cogs, Ingerson, and Ross model, it basically says that the volatility and the interest rate, something related to volatility and interest rate, it mentions, which is different in the Vasicek model. What is that? Let us understand. Here, the volatility and interest rate go hand in hand, means under this model, volatility increases with the interest rates. But in the Vasicek model, we understand that there is no such term. Why? Because we assume the volatility does not increase with the level of interest rate. So in the Cox-Ingerson model, the volatility increases with the interest rate. So we write volatility goes in hand with the interest rate. In the Vasicek model, the volatility is constant. It has nothing to do with the interest rate. That's why in the model, that interest rate part is missing. Got it? Also, what is common under both the models? Under both the models, they are mean reverting. Mean reverting. Mean reverting. Mean reverting means they eventually come back. If they are too high, they will drop. If they are too low, they will increase. Right? Vasicek model has one disadvantage, that it does not force interest rates to be non-negative. However, from the exam point of view, you need to understand that one very important thing about these two models, that they both assume mean reversion. Both of these models, equilibrium models, they both assume what? Mean reversion. They assume that mean reversion means reverting, means interest rates, if they are too high, they will fall. Otherwise, if they are too low, they will rise. Now, arbitrage-free model, how are they different from the equilibrium models? Just to give you all a brief, arbitrage-free model assumes that the price is correct. So if you see here, they begin with the assumption that the current bond market prices they are correctly priced. So the prices are already correct. So they start with the assumption that prices are correct. Now, if you look at the formula for both is the same. The only difference in both the model, Holy model and KWC model, the only difference is this assumes log normal. Holy model is based on normal distribution. KWC model is based on log normal distribution. That is the difference between the both. And how are they different from the equilibrium structure models? Here, since the prices are correct, we do not require the assumption of mean reversion. Do not require assumption of mean reversion. When we will do case study, that time you will understand this. Okay, so whenever we are going to do vignette, I have put a question related to this vignette, so you will understand how they test this micro difference. Clear? Both are single factor models. But then do I have to remember the formula? No, you don't have to remember the formula. Okay, I'm telling it upfront. Now, the only multi-factor model that is discussed here is Gauss plus. Gauss plus is an amazing model because here it takes into consideration not only the long term but the short term and medium term rates also. So it's the only model which takes into consideration long term, medium term, and short term. Now, what do they discuss about the long term rate? They said that long term rate is mean reverting, and it is dependent on the macroeconomic variables. It is dependent on macroeconomic variables. So it is, I will write down, it is mean reverting properly. We'll write down, it is mean reverting and depends on macroeconomic variables. Means it depends on the GDP and so on. Correct? This is what the long term rates are. Clear? Medium term rates will eventually match to the long term rates. Gauss plus says that the medium term rates will revert to the long term rates, and the short term rates. Who determines the short term rates in the market? It is determined by the central banks. So it is determined by the central bank, the rate of central banks. They are random because they are dependent on the central bank's policy. So they generally are random. It's a random component. These are dependent on the role of the central bank. And therefore, they say that because of this, the volatility is hump shaped. Hump means like a curve. The result is a hump shaped volatility curve. So Gauss plus incorporates all the three. Clear? That's it. This is where all the three readings, which are dependent on interest rates and the valuation of the bonds, option free and callable and puttable, and different sections of interest rate that we discussed, these three topics are connected. So if you see in 2 hours, you can revise, you know which points. I'm not saying this is enough, but basically it tells you how things are interrelated. Clear? Got it? So now we are moving to the last two readings of the fixed income. Out of the five, you have the first three related to valuation. Now we are going to go to the individual readings of credit analysis models, where we are going to extend our discussion about the bootstrapping arbitrage-free valuation model. And we are going to calculate something called CVA. This topic is all about calculation of CVA, that is credit valuation adjustment. Now, this is basically credit valuation adjustment is nothing but the present value of all the future expected losses. So, what is CVA? To focus on CVA, it's nothing but the present value of all the future expected losses. So, for this, you need to understand several formulas. However, when you do an example, you realize you don't need all of these formulas. To just give you an idea here, if you look at this information that we did in the class, what is a CVA? CVA is that how much you can lose in a bond. Okay. So whatever is your bond's price, that price of the bond today and what will be the bond's price after each year, that is the exposure. Out of that exposure, how much you are expected to lose, that probability of default and the loss that can happen when it defaults, all of these information will be provided to you. For example, here if you notice, expected exposure, recovery rate, and loss severity. Expected exposure is the amount that you are exposed to in case if the bond defaults, and how much you will lose, that is loss severity. Opposite of that is recovery rate. So if the loss severity is 40%, the recovery rate is 60% or vice versa. Now, another thing that you need to understand is the probability of default, which will be generally provided to you. This probability of default The opposite is probability of survival in a specific year. But if I want to find what is going to be the probability that it will not default in first year, but in second year, it naturally assumes that I will survive in the first year. So I will survive in the first year, and if I default in the second year, that cumulative probability of default is called hazard rate. So what is hazard rate? It's a cumulative probability of default in that year, assuming you did not default in the previous year. For example, let's say the probability of default year is 2%. So the probability of survival is 98%. Correct? Now, if I survive in the first year, then comes the second year. In the second year, the probability of survival and default is the same thing. But when I want to look at what is the cumulative probability of default in the second year, or the hazard rate, what is the hazard rate? The hazard rate takes into consideration that I will default in the second year, but it also assumes that I did not default in the first year. So when you do 2% and do 98% of 2%, that is 1.96 percentage. Is what is this 1.96 percentage? This 1.96 percentage is the cumulative probability of default in the second year, which is 1.96 percentage. Now, same way, if I want to find the probability of default in third year, that means I did not default in the first 2 years, isn't it? So if I want to find the cumulative probability of default in the third year, that means I did not default in first year, in second year, and I defaulted in third year. So it is basically 2% into 0.98, not default in first year, into 0.98, not default in second year. That is 1.92 percentage. That is going to be your probability of default. Once you get this probability of default and the loss given default, two things will give you your expected loss, and the present value of your expected loss is your CVA. So what I'm going to do is that I'm going to write down all the formulas step by step. First, we need to find what is the loss given default. It is basically your exposure. Whatever is your exposure, exposure is nothing but the present value of the bond. Present value of the bond, correct? That's your exposure. Times what? Exposure into how much you will lose if the bond defaults. That is called loss severity. Loss severity is the proportion that you will lose, right? So it is into loss severity. Sometimes they give you loss severity, or sometimes they give you they give you recovery rate. So you know 1 minus recovery rate percentage is your loss severity. So if they don't give you loss severity, you can utilize 1 minus recovery rate. That is my first formula I need. Second formula I need is the probability of default in a specific year. This is nothing but my hazard rate, which is probability of survival in the previous years multiplied with the probability of default in the specific years. This will give me my probability, cumulative probability of default. Understood? So what is going to be my cumulative probability of default? At a specific time, you need to take the probability of survival in the previous year into the probability of default. Got it? When you multiply these two, 1 and 2, that is loss given default, into the probability of default of that year, that will give you your expected loss, or it will give you your expected amount that you will lose if the bond defaults, right? So this is going to be your expected loss. And these expected loss, when you bring it to the present value, so the present value of all future expected loss, that is nothing but that is called my CVA, credit valuation adjustment. Now, this CVA is itself, if I were to connect, because we are in the revision mode, we can connect. This CVA is the amount that you will lose if the bond defaults, right? So if the bond defaults, that is a very crucial thing. If the bond defaults, can a risk-free bond default? Can a risk-free bond default? Everyone in the class, the risk-free bond cannot default, right? So a risk-free bond cannot default, a risky bond can default. The difference between the both, can I not say that is CVA? So CVA can also be said as the difference between a default-free bond and a risky bond. So value of a bond if it does not default, value of a bond when it will not default, value when it will not default, and the difference between this and a risky bond is your CVA, isn't it? So value no default, we use a word VND. VND is the value of the bond assuming there will be no default. And what is CVA? CVA is the value if the bond defaults. So from the risk-free bond, if I remove or subtract the CVA, that's how I will get the price of the risky bond, isn't it, everyone? So that will give me the value of a risky bond or present value of a risky bond. So if I want to find the value of a risky bond, everyone, see, remember the yield of risky bond is higher, so its price is low. The yield of risky bond is higher, so its price is low. So its price is low compared to a risk-free bond, no default. The difference between both is your CVA. See the connection, CVA, expected loss and probability of default and loss given default. Honestly, these are all the formulas that you need. Understood? Throughout this particular topic. So you will see the CVA is nothing but the difference between the risk-free and the risky bond, correct? Okay. We will see a case study or vignette to solve this. Okay. And we will complete the entire table as well. Okay. Now you can use, if they give you a binomial situation where they tell us that if the bond does not default, you'll get the par value on maturity, right? If the bond defaults, then how much you will recover? That is the amount that you will get if the bond defaults, correct? Now, those are the only two possibilities if the bond defaults and if it does not default. If it does not default, it will give you your full value. Now, based on those situations and with the current price, you can actually find the probability in the binomial. That is what is we call as implied probability of default. So implied probability of default, what is implied probability of default? Generally, we assume a hypothetical probability here, probability of default. But if I want to find the probability, so they've given if the currently the bond is trading at 95 and if the recovery rate is 60%, means you will get $60 if the bond defaults. So if I'm going to get $60 if the bond defaults and 100 if it doesn't, the present value of it is 95. Also, I need the risk-free rate to bring it to the present value. If you reverse calculate this, the probabilities that you get are called the implied probabilities. Implied probability of default, you can derive it from the market price. Clear? There is some discussion about the ESG green bonds. WHO had issued pandemic bonds also. So these are the different types of bonds issued for some specific goals. Okay, clear? Yes. Now we will go further into the discussion of the credit risk. Credit risk is basically relative credit risk. Relative credit risk is where you are going to discuss. Now gradually we'll move to the discussion of the spread. So here we have actually calculated which of the bonds has the highest credit risk. So what we did is that we calculated each bond's exposure. We saw which bond has the highest exposure And the one which has the highest exposure or highest expected loss or lowest expected loss is what we might be choosing up. So based on the expected loss, they have mentioned your bond Z has the highest risk. So expected exposure tells you how much riskier the bond is. Okay. Until now, the same formulas that I have written, that is what all we use. Credit scoring is for small business and individuals in US. There is a FICO score. Credit rating is for the bonds issued by the companies, right? Mostly we go for the S&P 500 rating, and we know higher rated bonds have lower spreads. Clear? Okay, no difficulty in this. Credit migration is a situation where there is a change in the credit rating. Okay. So whenever I want to find the percentage change in the price of the bond, we look at duration and we look at the change in the yield or change in the white yield curve, change in the YTM or change in the spread. Doesn't matter. So if I want to find the change in the price of the bond, I will write down here percentage change in the price of the bond. Normally we look at any of the duration. You can take modified duration of the bond, which is always negative, into percentage change. Sometimes they use YTM, or you can use change in yield curve, or you can also use change in spread. You can use either of the thing, right? You all will give you percentage change in price of the bond. Of course, there is a convexity effect also, which you can take into consideration. Okay. Next, what do we have here? Yes, these are the structural models and reduced models. What are these models? These are models of corporate credit risk. So let me write down models of corporate credit risk. Models of corporate credit risk. There are two types of model: structural models, and then you have reduced form models. Reduced form models. I'm using both because there is a high chance they may ask us for comparison of the both types of the models. Now, what is the difference between that? Structural models are based either on the balance sheet structure, okay, where you are going to use the option analogies, right? And the reduced form models, they are based on the factors which are external. So structural models are based on internal factors. That's why we call it endogenous. Based on internal factors. Internal factors. These are based on external factors. So that's why these are called endogenous, and these are called exogenous, outside factors, internal, outside, right? They use option analogy. So within the structural models, you have from the call option point of view and from the put option point of view. So here, what we do is that we value the equity of the company. Remember, equity of the company from the balance sheet point of view is total assets minus total equity, right? So we are going to value equity, we are going to value debt. Remember here, we use the understanding of the balance sheet where the total equity is nothing but total assets minus total debt. This is what we assume. So when we are going to the valuation, we will take into consideration option analogy. Okay. To see, because in the company, the debt and equity both don't face the same risk, right? Both face slightly different risk. So here, value of asset is equal to value of debt plus equity, or value of equity is value of asset minus value of debt. Correct? Now, they are saying value of equity in a company. Equity will get more value if the company makes profit, right? If the companies don't make profit, equities won't get any share. Clear? So when the value of the company's asset is greater than the value of debt, equities benefit. But if it is below debt, equities, of course, debt will lose, but equity will get nothing. Okay. So let me first put up the conclusion here that whenever the value of the company increases above, whenever the value of the company increases above debt, equity shareholders get a benefit. They will get a higher value. But whenever the value of the company goes below debt, equity shareholders will lose. So what should I write here? Value of equity and value of debt. Value of equity is maximization of zero, or either they will get zero or a higher value. Correct? So we can directly write here, it is maximization of, either they will get zero if the company value drops, or they will get the difference, the additional value over what is supposed to be paid to the debt. Clear? This is what the equity shareholders will get. Debt. Debt is slightly complicated. Debt won't get more than the value of the debt, but they will lose if the value drops. So in the case of debt, we use slightly differently. We say the minimum of, either you will lose the amount, correct? The minimum of the value of the asset or the value of debt, whichever is lower is what you will get. Let's say the asset becomes zero, so you won't get anything. If the asset becomes 20, you will only get 20, or the maximum is what you will get is the value of debt. Clear? Now, apart from this, they have basically also mentioned that what type of option position it is. If you are invested in debt or equity of the company, what type of option position it is. So value of equity is like you will at least get some value or more. So it's like a long call option. It's like a long call option. But when you're an investor in a debt, you will lose when the value goes down, but you will not make more gains when the value goes up. It's like which option? It's like which option? It's like a short put option. Remember, a short put option will lose if the value goes down, but it will not gain enough when the value goes up. So having an equity position is like a long call option position, and having a debt position is like having a short put option position. This is what you need to remember from the exam point of view under these endogenous or structural models. Understood, everyone? Clear, clear, clear. I have written a lot of things. You don't have to worry about that. You just have to remember this. Clear, everyone? Now, reduced form models and the structural models. The biggest advantage of structural model is that they use option pricing again, but they also explain why default occurs. Here, comparatively, they do not explain why default occurs. They don't explain why default occurs, which the reduced form models. There's no calculation in it, right? They are exogenous. They are because of outside factors. They basically focus on the default intensity. So they are statistical in nature. Statistical, and they focus on default intensity, the impact of the default. They don't tell us why the default will happen, but they focus on the impact of the default. So see here, they are exogenous, default intensity, right? So they tell us that how much is going to be the impact, but the disadvantage is that they don't explain why the default will happen. Understood? And here, under the reduced form model, they treat default as a random event. So even default is treated as a random event. Suddenly, random event, not related to anything. So it's quite statistical in nature. That is also a disadvantage because default is never random. It is due to various factors. Correct? It's not a surprise. It is due to a systematic failure. Clear? So that's a problem. Understood, everyone, about the different types of models of corporate credit risk, right? The two models. Mostly in exam, they will ask you a comparison amongst the two. Okay, clear, right? Now, most of the other things are just the similar discussion. What I've already done. We will see a case study or a vignette where we will cover all this thing. What is other important thing that I wanted to highlight here? Check, 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 check. This is all on, just when you read it, you will see all this makes sense. There's no complication here. Then the topic discusses eventually about the credit risk involved in a securitized debt. Securitized bond, right? Securitized option where you create an SPE, correct? So secured debt under which you have a collateral pool. So in the class, I had basically shown you how the securitization takes place. This example. Okay. So basically, how the loan portfolio is transferred from the bank to the SPE, and the SPE eventually sells these securities, right? So what is the risk here? The biggest risk is how the collateral pool is, whether it is diversified or not. Okay, if it is diversified, what is the opposite of diversification here? Called as homogeneous. So diversified, homogeneous. And how will I know what is exactly in the pool? That is called transparency. So granularity is transparency, and homogeneous is the opposite of diversification. These two issues we need to discuss when it comes to the pool. So when I want to analyze a securitized debt, my major concern will be on the quality of the collateral pool. And two important things are homogeneity and granularity. Granularity is a good thing, transparency, and homogeneous is not good because that is not diversified. Diversification is good, right? Correct. So see this short-term granular and homogeneous structure. It's a risky thing, right? Correct. Now, such a thing need to be evaluated statistically for short term because they are very volatile. Medium term, you can use portfolio based approach. You can use a broader approach, but discrete and non-granular, you should evaluate each and every bond. Okay. Before that, let me tell you a more discrete bond portfolio of few loans would warranty examination of each. So when there are very few loans, right, it's a bad sign. Okay, then you have to evaluate the risk, correct? A high granularity means would have hundreds of clearly defined loans. That's a good thing, correct? So you can just take a sampling and evaluate them. Got it? So granularity and homogeneity is very important when it comes to secured debt. Correct? Their collateral pool. We are evaluating what are the risk factors that you need to take into consideration. Do I need to memorize all these things? No, you need to understand the names. Homogeneity is risky, granularity is transparency. Okay. The quality of the servicer who is going to make sure the amount is transferred from the collateral to the investors, and the structure, tranching, credit tranching, where the risk is diversified across the different tranches. That is also very important. The senior tranche faces the least risk. Got it? An alternate to the securitized bond is the covered bond. Covered bond does not require the securitization structure of creating an SPE because the pool remains very much the responsibility or liability of the bank itself. So there is no SPV required, and because the risk is taken by the bank, so you have double protection or dual recourse, and therefore there is no need of credit enhancement. Credit enhancement, one of the example of external credit enhancements is taking a third party guarantee. This is required when you are investing in a securitized bond, but if it's a covered bond, that is not needed. Covered bonds are very famous in Europe and other parts. Clear? Okay, got it. This is all that you need to know about the topic of credit risk models. Now we go to the last section, that is CDS, credit default swaps. Credit default swaps. Credit default swaps. Yes, CDS. Here it does matter a lot whether you are many students get confused with who's the protection buyer, who's the protection seller. So what I'll do first is that I'll clarify that we did in the class note also. Protection buyer is the one who's giving up the credit risk. So it's called short credit risk. Let's write this in CDS, credit default swap. Protection buyer and protection seller. Protection seller is like that insurance company. Protection buyer is called short credit risk. And protection seller, the one who's taking the credit risk, he's called the long credit risk. Remember this throughout the syllabus if you get confused. This is the most important thing. If you forget everything else in the syllabus, fine. Don't forget this. Got it? Now, just for your reference, the protection buyer will pay to the protection seller regular premiums, isn't it? The protection buyer will pay to the protection seller regular premiums, and the protection seller, protection buyer, by the way, is my short credit risk. This guy is a long credit risk. Protection buyer is going to pay regular premium, which is in the case of credit default swap, I'm going to pay them regular premium. It can be fixed or anything. And whatever is the default on the bond, that will be paid by the protection seller to the protection buyer. Premium is, of course, paid upfront. Now, the protection seller, if the bond defaults, he will pay to the protection buyer the market value of cheapest to deliver. Yes, this is interesting. So we are going to see what is cheapest to deliver. What is cheapest to deliver? Okay. So there are two types of CDS we are going to discuss: single name CDS and an index CDS, where there is a portfolio, right? Single name CDS is where you're facing the risk of a single bond issuer. Correct. Now, in this case, what is cheapest to deliver? I had taken a couple of examples here. For example, if the bond defaults, you need to match two things. In the single name CDS or in the index CDS, you need to match two things. What are the two things that we need to match, guys? We need to match the seniority. So if this bond is a senior unsecured bond, we need to, what is cheapest to deliver? You need to find which is a senior unsecured. These two out of the ones which is the cheapest bond, the one which is trading at a higher discount or a lower discount. See, the one which is trading at the lowest value of the par, this is the cheapest bond. So that is 45% discount amongst 45 and 50, the one which is available at the lowest value amongst the same maturity, amongst the same credit level, okay, or amongst the same seniority. That bond will be considered in order to pay if the bond defaults. So here, how do we process it? So suppose here the protection is taken on a 10 million security, right? Of subordinate of which bond? Senior bond. So you will only look at senior bond, and 25% par or 30% par, 25% par is cheapest to deliver. So 25% of the par, $25 value. We are going to assume that, okay, a bond which was 100, now it is trading at 25. So 75%, the balance will be paid off to you. So out of 10 million, 75% will be paid off to you. That is going to be the payoff in case the bond defaults. Understood, everyone? Correct. Correct. This is how we utilize it. Okay. We do the same for an index CDS also. In case of index CDS, the only difference is that out of the entire pool of, let's say, 100 million was the pool, and 125 entity, let's say one default. So 100 divided by 125, that is 0.8 defaults. In that, the cheapest to deliver, they have said 30% par, so 70% will be recovered. So 0.8 into 0.7, 0.56 will be recovered. And now out of the entire pool of 100, 0.8 is out. One bond is out. So 99.2 is the new pool. So the new pool or the new notional principal will be 99.2. Understood this point? Clear, clear, clear. Now, all of this depends on a credit event. What causes credit events? Bankruptcy. I discussed different types of Chapter 11 and so on, right? That's a bankruptcy in US. Chapter 7 is you just go out of the business forever. Chapter 11 is where you can reorganize, correct? Okay. Now, these are the events forced on which the companies will see. There is an agreement between the protection buyer and seller as to what will cause default. That event is decided. Understood? Clear? What else did we have in this topic for us to remember to do something important? Now, see, there are so many formulas here. I would suggest you do these formulas only if you have time. You don't have to memorize most of these formulas. Just that you need to understand that the premium is paid upfront. The premium is paid upfront. The formula of premium is quite complex. I've explained that in the full course. If you have time only, then you can go for it. One thing you can here understand is the CDS spread. CDS spread or CDS premium. So the premium is basically CDS spread, which is the default rate into the probability of default. How much you will lose if the bond defaults into the probability of default. This one formula you can remember from the CDS spread. I will write down what is the CDS spread in percentage is actually the default amount, which is 1 minus recovery rate, 1 minus recovery rate into the probability of default, POD. That will give you the CDS spread. If you have to remember any formula related to the CDS spread, just remember what is a CDS spread. Okay, clear, right? Plus, there are several formulas about the upfront premium. See, the premium is decided in such a manner that the present value of inflow and outflow should match. Okay, so the premium and the protection, like that's how the premium will be decided, right? So premium should be beneficial to the protection seller, isn't it? So whatever is the premium that I'm going to receive as a protection seller, I will have to compare that with the payoff that I'm expecting to pay, which is nothing but CVA, isn't it? So how much will be the premium? That depends on how much the seller, basically the premium is going to be quoted by the protection seller. So he will compare two things: how much premium I will receive, that's an inflow, that should be higher than the loss that I'm expecting in case the bond defaults. Correct? This is what you need to keep in your mind. The rest of the things, I would suggest you do it only if you have additional time. Okay? Understood? Clear? What is more important here is what is the profit for the protection buyer? When does he make profit? He makes profit. He makes profit when profit for protection buyer is when the spreads go in his favor, right? So change in the spread and how much is the spreads impact on the bond, that is what we go with the duration, isn't it? So change in the value of the CDS, that will cause me profit. And how will I get the profit? The profit for the protection buyer. Yes, this is the second formula that we need to remember. Profit for the protection buyer. Okay, for the protection buyer in CDS. In CDS, when will the protection buyer make money? Here, the profit can be calculated in percentage or in dollar. Very easy. Here, in percentage or in dollar. What is the only difference here? When you want to find in percentage, you need to find what is going to be the change in the spread, correct? Times the duration, simple. And when I want to find in dollar, I will do the same thing, change in spread, which is of course in percentage. So change in spread in percentage into the duration. And since I want to find it in dollar, what you can do is that multiply with the notional principal of the swap. So change in the spread times duration into the notional principal. That will give you the same answer in dollar. Okay, this is the second formula that you need to remember. Upfront formula they have given us, I would suggest you to do it only when you probably feel that, I'm done with the rest of the fixed income. Otherwise, I won't recommend you to go into the depth of it. Okay. Now we are going to discuss about the uses of CDS. This is very important. How do you probably make arbitrage in the CDS? Very recently, when Donald Trump actually increased the tariff, the equity market succumbed. He was not affected by it. But the bond market started reacting in a manner that he was forced to take back some of the tariffs, at least if not from China. So there was a very interesting theory that it was not the equity market, but the impact of the bond market which forced him to take back some of the tariffs. And one of the prominent reason given in that article was basis trade. What is basis trade? It is the difference in the credit spread that traders want to exploit. So it's between buying and selling a bond and buying and selling the CDS. So when you make a strategy between a bond and CDS, that is called a basis trade. So how to utilize CDS? You can utilize in earning arbitrage profits. So arbitrage or trading related strategies is what we are going to discuss here. I have done several examples in the class. So there are different strategies related to the usage of CDS. So I will write down here usage of CDS. In that, first, to make an arbitrage, I can use basis trade. First, basis trade. Just remember for your reference, basis trade is where you long a bond or short a bond and combine it with the protection, that is a CDS. If you think the CDS is cheaper, take the protection and buy a bond. Okay. If you expect the CDS spread is not up to the mark, so basically you'll have to make a decision between whether it is cheaper to take the protection or not. Okay. So see this just for your reference and example. It relies on the mispricing and temporary disparity. If the specific bond is trading at a credit spread of 4%, correct? But the similar bonds are trading at 3%. So basically you're getting a better spread, correct? So if you buy this bond, you're getting a better spread. So you can profit by buying the bond, correct? A trader can buy the bond and take the protection buyer position. Why? So I'll repeat. So see, for example, if the specific bond is trading at a credit spread of 4%, means it's relatively cheaper, isn't it? Over the MRR in the bond market, but the CDS spread is just 3%. So see, actually the risk is 4%, but the CDS spread is available lower, right? So the protection is cheaper. So whenever the protection is cheaper, you buy the protection and buy the bond. Understood, everyone? So combining, when will you buy the protection? Whenever the CDS spread is relatively lower than the credit spread. So I'll write down when the CDS spread and the credit spread. Okay, CDS spread and the credit spread. What is going to be the strategy here? When the CDS spread is lower, in that case, what will we do? We'll buy the protection. So we will buy the protection in the CDS. Now, when I say buy the protection in the CDS, means you short the credit risk. Okay. So buy protection with the CDS and long a bond. So you buy a bond and buy a protection, isn't it? Correct. Opposite also you can do when the CDS spread is too high, you can sell the protection and sell a bond. Correct? So you can sell the protection and sell the bond. So for your exam, I would suggest you to just remember one, don't go with confusion of both, and then just according to the situation play. So if the CDS spread is cheaper, buy the CDS and buy the protection and buy the bond. So even if there is a default, your protection money that you've paid is relatively lesser. So you've got a deal in a cheaper rate. Correct? So this is one type of a trade or a spread or a usage of CDS. Another type is basically where you're going to buy and sell two different bond instruments of the same company, but of different seniority or different different maturity. So this is basis trade, and then we move on to another arbitrage transaction involves buying and selling debt issued by the same entity on which instruments in the CDS market suggest to be under or overvalued. So the second arbitrage strategy is arbitrage, where I am going to buy, sell bond on same entity, same company, correct? But by comparing with this market CDS, okay, based on CDS. So based on the credit spread in the market. So looking at the spread, you will see which bond is available at a better rate. You will buy and sell, but of the same entity, right? Of course, they say arbitrage, but it is not completely risk-free. The third strategy is leverage buyout. Leverage buyout is actually where you borrow, correct? And you buy the shares, correct? So here, very interesting, LBO, the firm will issue a great amount of debt. So when I issue the debt, correct? I am the one who's not, I'm not, so the counterparty is worried about the default, right? So the additional debt will increase the CDS spread and the default is more likely. Investor here who anticipates an LBO might purchase both the stock and the CDS protection. So someone who's worried that with the LPO, the risk will increase, So in such a case, they will do two things. They will buy the equity because they expect that if it is successful, the value of the company will go up. So they will buy the equity. But since the company also becomes riskier, they will buy the CDS, or they will buy the protection, I should say rather. Why? Because by doing so, if the LBO is successful, I'll make money. But if the LBO is not, I'm protected. It's a win-win situation. Got it? Correct, correct, correct. Then you have index CDS, where the value of index should be equal to the sum. So index CDS, you will do an arbitrage between index and the constituents, right? So credit risk of the index and constituents is compared. That is my next one. That is index CDS or index arbitrage, is where I will compare index arbitrage, where I will compare the CDS of index versus the constituents, and whatever is the opportunity, which one is cheaper, I will buy. Got it? This is just informative. You don't have to calculate anything. And the last option, of course, is credit CDO, collateralized debt obligation. It's a claim against the portfolio of the debt security, right? So CDO, how do you make an arbitrage? Synthetic CDO. And so basically you will, CDO is the pool. You are basically buying a pool of the collateral securities. It will be having collateralized bond, debt, everything, right? So it's a claim against a portfolio of the bond. So it's a portfolio of bond, CDO, And when you combine this CDO with CDS, it becomes a synthetic CDO. So see, if synthetic CDO is similar credit risk that a cash CDO and all those things, they've given you extra information. You don't have to worry. Just remember, CDO is also combining CDO with CDS is also one of the strategies to utilize CDS, credit default spread. That's all information. I think whatever extra information is there, you can probably just not go deeper into it when you go into the revision. When you go into the revision, many things can be skipped. Got it? So, because you have done in detail in the first stance, so when you go to revision, all of this are the only aspect that you need to understand. Most of the aspect I've covered, if you just do these aspects, go for the exam, there is a high possibility that we've covered everything. So there is a high possibility that you will score well because you're going to get 2 or 3 vignettes in exam related to fixed income. Got it? Anyone, any doubt in this place? Okay, if not, then what we do now is that we go to the case studies or vignettes, right? Let's solve.